Well, thank you and good afternoon and welcome to the DoubleLine Webcast with Sam Lau and Jeffrey Mayberry. The title of today's webcast is Driving Season. Lastly, we do have another YouTube channel for thought leadership. That's DoubleLine Capital. There you can see a geopolitical roundtable hosted by Jeff Sherman, portfolio managers Bill Campbell and Valerie Ho, and then Ken Shinoda's Channel 11 also on the channel. We also have two podcasts. The first one, the Sherman Show podcast, the widely acclaimed Sherman Show podcast, and then Monday Morning Minutes with Sam Lau and Jeff Mayberry. Those are available at doubleline.com, iTunes, SoundCloud, Google Podcasts, Spotify, and Stitcher. So without further delay, I'm going to turn the webcast over to Sam Lau.
Well, thanks, Ron. And hey, and thanks everyone for tuning in with us today as Jeff Mayberry and I talk about the strategic commodity. And on the slide here, you'll see that we've titled this podcast, or sorry, not this podcast, this webcast, Driving Season. And I thought it was very appropriate given that driving season is marked by the start of it, at least by the beginning of Memorial Day weekend as the start of summer travel by planes, trains, and automobiles, and a nod to Steve Martin and John Candy here. But on the slide, we only have automobiles, but planes and trains certainly also require fossil fuels for power in the form of unleaded gasoline, diesel, or even jet fuel. So on the top picture here, we have American Muscle, both in red and the yellow variety here. And they look to be about circa 1970s. It kind of looks like a Starsky and Hutch car, for those of you who are old enough to remember, but minus that cool white stripe. So it got me a little bit curious based on these pictures. So I Googled the original Starsky and Hutch car and found that it was a 1975 Ford Gran Torino. And it had a V8 engine, acclaimed horsepower of 150 ponies under the hood. Did 0 to 60 in a purported 13 seconds, so a little bit slow by today's measures. But more importantly, it had a claimed miles per gallon of 14 mpg there. So it sounds like a gas guzzler, but you know what? It's actually, embarrassingly enough to say, it isn't that bad for an American muscle car manufactured back in the 70s, because my 2019 car right now only gets 15 miles to the gallon. So those are the two cars on the top there, and facing off with the Gran Torinos, potentially Gran Torinos there in the lower pick is new American production. I'm not going to call it American muscle, but it does showcase American ingenuity. And I believe these are Tesla Model 3s. So with that, in the similar vein, I Googled the Tesla Model 3, and it looks like this electric vehicle does 0 to 60 in 3 seconds, depending on how fast you're driving and which mode you have, based on a long-range mode or a performance mode. And it has a claimed equivalent to your old MPG. It's actually called MPGE, miles per gallon equivalent, based on electricity of 113 miles. So definitely more efficient from that standpoint. But it is faster. It doesn't require, and while it doesn't require direct fossil fuel input at this point, likely in 2022, the electricity that you use to power a pure electric vehicle probably has a good chance of still being generated by fossil fuels. So you're not getting away from it entirely for those of you who think they're truly green energy focused right now. So I guess the highlight of this and the theme of this webcast, at least in the initial part, where I'm going to talk about some of the background fundamentals and what we believe are longer term drivers of price support for commodities based on both the supply side as well as the demand side. It's really the old facing off with new. And that's what we're seeing today going on, especially in the energy sector, with what we've seen as a global transition trying to take us away from old school fossil fuels and perhaps industrial metals over to something like renewable green energy. And what I'll show in the upcoming slides is that this transition from dirty fuel to clean fuel is going to require a significant supply of the old school commodities for the build out of that required green infrastructure. So with that, we do think that commodities do have some price support from where we are. And moving on to the next slide here, you've seen that, and we all have kind of noticed it. I mean, despite the land of pains that you've seen in other traditional asset classes like stocks and bonds pretty much across the board, we've seen lands of gains in the commodities thus far, having a very strong run in 2022. The Bloomberg Commodity Index here on the year-to-date basis is up 33% through today. The S&P 500 is the other way around, and it's down 17% through today as well. And the ag, it's looking like it's going to be right around a negative 9% on the print for the year-to-date as well. So while we take a look at the this longer run chart of the Bloomberg Commodity Index, it still looks like, we're a ways away from the highs that were reached back in 2008. And when we take a look at that peak that was reached in 2008, that was on the back of maybe a 6-year run, or maybe even a 9-year run if you bring it back to 1999 and ignore that kind of that drawdown that we saw in 2001 and beginning at 2002. So based on that context, the current run that began in 2020 on the back of the pandemic looks like it could still have some legs left in it. There's still a little bit more gas in the tank, we feel like, from the commodity standpoint based on this chart. Another thing to look at on this chart here is that, that first super cycle, what people dubbed the super cycle of that strong commodity growth from early 1999 through 2008, the primary driver of demand there in that early 2000s period was China, which had just entered the WTO, the World Trade Organization, and they were taking massive steps to modernize their economy. Today, China is no longer the same driver of demand as it was 2 decades ago, but at least when we're taking a look at it on its own. But instead, for the 2020s, what we've seen, and also pretty much from 2015 on, I would say, we have had a consortium of over 190 countries that have signed and ratified this agreement to reach net zero carbon emissions by 2050 under the Paris Climate Treaty. And that endeavor across these nearly 200 countries is going to be commodity intensive and require and post that underlying demand, we think, for commodities. Before we go into some of the current drivers that we're looking at in terms of the price support for commodities, it's always helpful to look back and think about what the more evergreen rationale could be for investing in commodities. And when you take a look at it from the old school approach, Investment 101 tells you that you should look to introduce uncorrelated streams of return to your portfolio, thus having diversification benefits to your traditional asset classes. In particular here, keep in mind, for 2020, I think it's a great example with both stocks and bonds down so much, whereas commodities are up. But overall, by introducing commodities into your overall portfolio, you have the potential to gain a low to uncorrelated source of return to your traditional asset classes. Additionally, commodities, and we're really experiencing now on the back again of the post-pandemic stimulus aid-fueled inflation that we're seeing today, both in prices as well as in wages. But commodities are one of the better hedges to unexpected inflation. I think the reason behind that is somewhat intuitive, given that commodities are those physical assets, the raw resources that serve as the input into many of the consumer-based products that we buy. So in that vein, commodity prices tend to be the ones that lead inflation higher. So definitely we've seen this hedge to inflation working out through the commodity vehicles, where it has impacted negatively other traditional asset classes. And then, of course, you have the potential for incremental returns across each of the individual commodities market structure. We've seen that since 2020 as well. And then also commodity supply and demand is generally correlated to the cyclicality of the global economy. And I know there are fears out there that perhaps we're moving into a period of weaker growth, but it is still poised to be above trend type of growth over the next few quarters here. And then also, given that underlying kind of structural supply, undersupply, as also this kind of captured demand that comes from this clean energy revolution that we're talking about, we do think that could provide some further tailwinds for commodity prices. And then here on this chart, we have a matrix of commodities against your typical type of asset classes that you might see within your own portfolios here. And across the top, I should have drawn a nice little box across that second row, the one that begins with commodities and goes across and shows you the correlation across U.S. large cap, small cap, international equities, the various bond sectors, and then ending up with the dollar. But you can see there that commodities against each one of these individual asset classes here, or sectors of asset classes, does have a low to even times negative correlation to each one of these. But as a basket, when you take a look at it across all of these sectors, the average correlation of commodities to these other sectors here is 0.16. And one thing I would like to point out here, just given it's a little bit of a unique situation that we've seen thus far since about 2021 or so. But if you take a look at the very far right there on commodities versus the dollar index, you'll see that commodities have a very large negative correlation to the US dollar. As the dollar rises, then commodities tend to fall. When the dollar falls, the commodity prices tend to rise. But that's not what we've seen in this go around, starting in let's say around the late 2020 into early 2021. And what we have in this chart here is the relationship between a broad basket of commodities as represented by the Bloomberg Commodity Index, and that's shown in the black line there going back to 2009. And then the red line is the US dollar index. I believe it's the DXY or the Dixie that we like to call it. And that's in red there. And you'll notice on the right-hand side, based on the axes there, that the dollar index is actually inverted there. So to kind of better map out this relationship here. But as you see, with the red line in this case, then when it goes up, that means it's actually falling in value. And then when it drops, because it is inverted, you're actually increasing in value. So you can see here that the relationship is held out fairly well between the black and the red line between 2009 to 2020, kind of wiggling and jiggling in similar veins there. But something happened in 2020, late 2020, early into 2021, when you saw that the dollar gained in strength. And at the same time, rather than falling as you would think based on the direction of the dollar, you actually see that commodities continue to push ahead into the land of gains, continuing there. And I think a lot of that, again, comes from the supply-demand imbalance that we'll be talking about throughout this presentation here. So going back to the land of pain here, the traditional 60-40 portfolio as represented by the S&P 500 and the Bloomberg US bond index, you can see we track these type of portfolio returns by year going back to 1988. And where we are today is at the 2022, and this is updated through, I believe it's through yesterday, May 23rd is where the last print is, although I don't see it on the chart, but that's what that's what I recall it being. So with that, you can see as right around the time of 100 trading days into the year, this is the worst start through that time horizon for your traditional 60 portfolio. And this, again, kind of supports that thesis of, perhaps diversification and owning some commodities and getting a piece of that up 33% through May 24th would have helped improve your overall portfolio over this period of time. Taking a look at it at a more granular level here on the top section of the chart, we have the month-to-date performance for various sectors of various asset classes as well. Within there, broken out by equities, fixed income, FX, and commodities. And then on the lower part of the chart, the second half, there is the year-to-date returns. And you can see on the year-to-date basis on the bottom half again, pretty much there's been nowhere to hide. I mean, everything is red absent the dollar in this view here, as well as the commodity broad indices as represented by the Bloomberg Commodity Index and the GSCI basket as well. But then everything except for copper there on a year-to-date basis of the individual commodities that we've listed here are also in the green, and many of them massively so. I mean, if you take a look at the energy components, they're up around 50%. You look at agriculture, it's up almost 30% there. And then copper has seen some weakness, and you can see the industrial metals complex to the right of copper there, up 8%. Is a little bit of a laggard there in this land of gains. That's been suffering a little bit, as you can see from the month-to-date above, where you see the red bars in the copper as well as industrial metals there. That's been an impact on the fear of a slowdown in China around the zero COVID policy. But now we're seeing Shanghai start to emerge from their cocoon here. Perhaps we'll see this revert back. It does seem like in the recent days, we've seen a little bit of reversal there. But now I think eyes should be placed on another major city within China, the capital city of Beijing, which is now being shuttered in, I guess you can say, into their apartments again. So we'll keep watching out for that. But thus far, the green that you see outside of the US dollar on a year-to-date basis is in the commodity sectors, and the red is everything else. So let's move on to the current case that we have for commodities. I've already hinted at much of this, but our expectation is that we're entering into a somewhat prolonged period where supply of various key commodities are going to be challenged and undersupplied there. And a lot of it comes back to the investment, the capital expenditures that have been placed within both the production of energy-based products as well as mining projects around industrial metals. And there's been an underinvestment in it over pretty much the last decade or so. And if you were to recall the chart that I showed at the outset, there was somewhat of a lost decade for commodity performance in between the time of the global financial crisis. Let's call it around 2011 after the early rally off of the lows. But then from 2011 down to about 2020, there was kind of that lost decade in terms of commodities having underperformance, both on an absolute basis, but underperformance on a relative basis compared to equities and bond markets. So with that, we did see less emphasis placed on the future production of both energy through crude oil as well as industrial mining projects. And a large part of that is because of the shift in focus that shareholders of these publicly traded, oftentimes the biggest companies are the publicly traded ones. There's a shift in that focus from by shareholders from focusing on future production, because again, that lost decade of returns, why would you want to place your free cash flows to the expansion of more commodity supply in the backdrop of that declining price market? And instead, shareholders wanted to shift focus over to profitability for themselves. They wanted these publicly traded companies to increase their dividends, perhaps increase their shares of buyback. And that I guess that would have served to work if there wasn't this need for demand that would be arising from this transition to clean energy, as well as a few other things. But that in itself has served to kind of put us in this situation where we are in a period of being undersupplied on various key commodities, just at a time when we probably need it most. On top of that lack of investment or underinvestment, we've also seen, in particular, the E component of ESG, which has been a very hot topic and something that has been discussed across most boardrooms nowadays. But the E, as people probably know, stands for the environmental concern. And there's a certain amount of pressure on publicly listed companies to reduce their footprint, their carbon footprint, and also their destruction of strip mining, destruction of the earth through strip mining via the E in the ESG. So that can also exacerbate this market tightness as the social sentiment has shifted towards leaving the earth in a better place than what we found it kind of mentality. So with that, in terms of the demand side, the carbon neutrality and this transformation and this transition to clean energy is going to, ironically enough, serve to increase the demand for a lot of these old world economies. If you think about the use of energy, again, the diesel, the gasoline, the jet fuel that's going to be required to not only transport, but also build the physical infrastructure that's needed to basically rejuvenate our infrastructure here around energy, not just in the US. When I say I mean globally. This has to happen across the world because, again, I think it's around 195 countries that have signed and ratified that Paris Climate Accord. So in addition to that fuel that's required, you're also going to need the building blocks, the building materials that industrial metals bring. So we do see this as the underpinning for a kind of a consortium, again, of countries that are going to lead to this demand for commodities to replace that one China country back in the early 2000s that prompted that first super cycle in commodities. And then, of course, unfortunately, we do have geopolitical event risk that seems to live with us daily here. And the unfortunate events, what we've seen with the Russian invasion of Ukraine is it has severely exacerbated the supply chain for for many commodities, particularly energy for European countries, but that certainly has had knock-on effects across the commodity complex as well. But getting into some of the details behind what I've been talking about, kind of hand-waving about, is the slowdown in capital expenditure in the production of energy. I'm going to focus on energy first and then moving to industrial metals. But here on the chart, going back to 2000, you can see there's the ramp up in capital expenditures going beyond even the global financial crisis and beyond that peak in 2008. But you saw that the expenditures and the investment in these areas kind of peaked out in 2014 or so before dropping down through 2020. And that in itself has impacted supply of crude oil. And given the fact that it's not a Fed money printer, you can't just flip a switch and print out new commodities, new oil like you can money nowadays via the central banks. This is a very long cycle type of production right here. And when you're talking about going from the decision to produce oil to the exploration and sourcing of that oil to the actual mining, or not mining, but the drilling, especially on offshore rigs, some of the longer cycle projects there, those can take up to 10 years for you to really go from decision making to getting some oil out of the ground. It's not just like the Beverly Hillbillies where you take an errant shot and all of a sudden oil comes out of the ground there. So we are seeing this last 10 years or last 8 years or so of relatively lower investment in CapEx. And from what I understand too, based on the research, a lot of this CapEx is actually just going into the maintenance of existing projects rather than the exploration of new wells. So on this chart here, I have the total U.S. crude oil inventory. It looks a little bit weird on this chart, but if you were to look at the gray shaded area that is range bound by the two black lines there, that is the total crude oil inventory, including that of the Strategic Petroleum Reserve here that we have in the U.S. going back for the last 10 years. So from 2012 to 2021. And you can see along the horizontal axis on the bottom, you have the various months for each one of those years. So effectively what this gives you is a seasonality type of chart. And then all of those years, the 9 years between 2012 and 2021 are represented through that shaded portion, with the dotted being the average for that 9-year period. The 10th year is where we are indicated in the red. That is 2022. And you can see, and I would point out two things here. One is that it started out fairly low at the low end of that let's just call it the 10-year range now that we're including it. But beyond that, we're significantly lower than the overall 10-year range, especially at a point where if you take a look at the trend from, let's say, January out to the beginning of May into kind of June, is when most of the time you see a build in inventory. And that's because, again, we're heading into driving season. We're heading into peak travel season when people like to get on the planes, trains, and automobiles, fire up their cars, fire up their diesel-fueled trains and their jet-fueled airplanes there, and really get out on the road for summer vacation. So during that period of time, there's usually a build in crude inventory in order to kind of meet that demand for the distillates that are used to power those vehicles that we're talking about here. But right now, we're in the other way around, where that red line is actually trending down, and it doesn't look like it's abated at all. So we'll continue to monitor to see this, but you can see we're at multi-year lows, just at a period of time where for oil, we're probably going to be needing it at a higher amount given the driving season just around the corner. So with that, here's a nifty little ratio that people take a look at, and it's basically the crude oil stocks to use ratio. And you can see that's at multi-year lows. The ratio is calculated by just taking a look at how much inventory we have relative to the amount of demand, and we're just off of the lows here going back to 1998. The next view here is on the distillates I mentioned. It's a very similar looking chart to the crude oil. This is basically the products that come out of the foundation of crude oil here. So you can think about it as your diesel, your heating oil, gas oil, and gasoline. But again, we're at the lower end of the range, just at a point where we should be amping up the inventory build. We're on a continuous draw here, so it doesn't bode well right now. Yesterday, when I was driving up, the local gas station was at 7.08 for a gallon of premium. It's the first time I've seen it over 7, and it's gone the other way around since when Biden back in March 31st announced that he was going to release up to 180 million barrels of crude oil from the strategic petroleum reserves. And this is what I have on the chart right now. If you take a look at it, this goes back to, I want to say, 1982. Really, the SPR, as it's known by its acronym, was created in 1975, and the first shipment of oil touched the salt caverns back in 1977. But this, for some reason, is as far back as it goes. And you can see from 1982 out to maybe around 2009, 2010 or so, we're in a period of build for the most part. I mean, there's periods where it just stayed stagnant, but during times when I suppose oil's cheaper, they look to build oil, or perhaps as well as if the demand is increasing. They just want to have the buffer. The Strategic Petroleum Reserve was created to act as a buffer against future oil shock. And recall that I said it was legislated back in 1975. That was on the back of the OPEC oil embargo, which I believe was in 1973 or early part of the 70s. So it's designed to be a buffer against real oil shock. But you can see what we've been doing since basically 2015 is we've been on a draw. And usually these things are supposed to be here to draw from if there's an oil shock, let's say from a geopolitical event or from a natural, perhaps like weather event, like hurricanes taking off some offshore pipelines there. So with that, we've been drawing down, but there hasn't been as many of these events that you would think of based on those things I just described there. But really what's been happening is since 2015, Congress legislated a law that we can actually sell forward from our Strategic Petroleum Reserve to right now it's largely Asian countries to help fund the budget. So that's a little bit of political insight there. So that's been on the decline. But what looks to be a capital I here on the right-hand side in black, that is at the top part of the I where it crosses and intersects the blue line is when President Biden made the announcement that the release would come. You can see we're currently about 30 million barrels less than that. So it's about 17% of the way there if we were to actually go to 180 million barrels. But if we were to drop it down to 180 million barrels, you would be down to somewhere around 380 million barrels in the Strategic Petroleum Reserve. Just in time for us right on the back of driving season, we're about to enter into hurricane season. So if pipelines go offline on that, the Strategic Petroleum Reserves are on current draw right now at an accelerated pace. Hopefully we have enough buffer there to kind of defend against that in the future. Other countries across the world are in a similar position. These are the OECD countries, of which there are 38 members, including the US, also in a very similar predicament there. And then oftentimes people will ask, it's like, well, can't OPEC fill the gap? In fact, I think the administration has asked OPEC to fill the gap, and the OPEC came back and said, no, we're being cautious with the way we approach things because we don't want to oversupply the market when it's not necessary. But I think if you look under the hood on what they're saying, what we have here on the chart is a piece from Bank of America, and it shows the OPEC spare capacity estimates. And this is as of February 2022, so 3 months ago. And you can see right now the spare capacity, and spare capacity is how much the max capacity is relative to what they're currently producing. So the differential there is the spare capacity, how much they could potentially bring to market if they needed to go full capacity, if they're even able to go full capacity based on maintenance. But you can see here that the spare capacity is highlighted by the kind of the bluish, like what's it called, the fruit stripe type of gum that looks like the blue flavor, and then the yellow flavor. Yellow flavor is the Iranian spare capacity, and the blue is the other remaining OPEC countries. Altogether, on the right-hand side, you can see that the summation of the spare capacity and Iranian spare capacity is just under 4 million barrels a day that they can bring to market if they needed to. And since they've been increasing that since February by smaller increments, I think it's safe to say that we're lower in spare capacity than we were just back in February. One of the keys for demand for oil has come in from driving. You can see it's not just a U.S. phenomenon or even a developed market phenomenon, but across the world, we've been seeing a strong recovery in driving trends to the point where now in 2022, we're near the highs going back to to pre-pandemic just through January 2020. So now that we're entering driving season, we'll see where this goes, but we'll keep an eye on that. One area that hasn't recovered in terms of trains, in terms of transportation rather, is the planes section of travel. And you can see passenger air travel is yet to recover. Going back to December 2019, we're still well below, for the most part, across all countries here. The big outlier here is the Asia Pacific. They do have much more onerous restrictions and quarantine measures in place that perhaps cut some of the freedom of travel around there, amongst other things. But with that, you have the other parts of the country that look like they have been on the road to recovery. I know for ourselves here, we've been doing a lot more business travel. People are getting out on the road, also for pleasure more. I should say getting out there in the air more for pleasure now. So we'll see how this continues to trend up. But my sneaking suspicion is that it will continue to go up. I do see we're getting a little bit closer on time, and Mayberry's probably cursing me on mute here, but let me just go through these industrial sections real quick, and I would focus your attention here to the dark blue bars here, and this is the amount of capex that has been taking place globally going back to 2000. Very similar type of trend that I showed you earlier with oil production. You can see that it peaked around 2012, and it's been on the downtrend since then. Post 2021, I want to say, are estimates here, but the estimates, if they aren't updated, do seem to be pointing lower as well. And this is a big issue because, as I mentioned, the renewable energy transformation, that's highlighted in green across these various pie charts. On the top left, you have the 2020 mix of energy production. You can see that the green section only represents 12%, but by 2030, it's estimated to increase up to 42% and then 55% of total energy generation by 2035. And if you think about 2050, while it's not listed here, if we are trying to get to that net zero, a la the Paris Climate Treaty by 2050, you would imagine the renewable section to be much larger component of that overall pie. And why that's important is when we take a look at the demand for various industrial metals in order to create this infrastructure, we're focusing here on copper, but it is representative of the other areas like aluminum, nickel, and zinc, all of which are the building blocks, again, for physical infrastructure, especially so for these clean energy source type of vehicles here. So looking across here, everything to the right of that vertical dotted line is an estimate and a projection of where we are going to have to go based on demand to meet this energy transition. And you can see the biggest part of driver of the growth is going to be from electric vehicle demand. So it's that white car that I showed you in the beginning that did 0 to 60 in 3 seconds and something like 150 miles per gallon equivalent of oil there. So that's going to drive a big part of the copper demand, but also wind and solar is going to be a big component of that as well. Here, really quickly, your conventional cars. So my 2019 gas guzzler probably sits in the middle of the conventional cars. Let's just call it 35 pounds of copper is required. But if you go into your Prius, that's around 85. If you go into your plug-in hybrid electric vehicle, that takes 132 pounds. Your Model 3 takes somewhere around 183 pounds. And then if you're to go into a battery electric bus, which I think would be, some of those orders are already in across multiple cities and countries, that's a whopping 814 pounds per vehicle there. So illustrating the fact that there is going to be a strong demand if we are all on board to get to carbon neutrality by 2050 as we build there. So with that, when we take a look at the projected electric vehicle sales, those are projected to exceed the sales of new vehicles of your standard internal combustion engine vehicles by somewhere in the mid to late 2030s. Now, if you can draw your lines here on the left-hand chart here, the dashed line is where we are globally. The red line you can see is China, and the teal line is Europe there. You can see that they're on a faster pace. They've made a bigger initiative to get to kind of electric vehicles. And for China, it makes sense. They don't produce any real crude oil there. So for them to move away from the U.S. and dependency on crude oil that might come from the Middle East is a big strategic move for them. So they've been early adopters of this. But you can see globally, it looks to be around 2035 is when the rest of the world, on average, catches up to 50-50 sales between ICE vehicles and EVs. But that doesn't mean the death of fossil fuels that's going to be required for fueling up your internal combustion engine. You can see on the chart on the right there that it is still, while it's on the rise through 2035 and it does decline slightly from 2035 on, it's not going to disappear immediately. You're still going to have a big component of transportation that requires fossil fuels. And right now, transportation is roughly, I want to say, if memory serves, around 70 to 75% of total energy consumption for fossil fuels right now. So definitely a key component, isn't going away anytime soon. It's going to diminish in size, but it will still be present in our garages most likely past 2035. And then finally, the last chart for me is this annual investment that is projected to be required to get to net zero emissions. And you can see each year, with culminating with a peak in 2036, is anywhere between about $1 trillion, let's say, out to just under $3 trillion per year. That's going to be required globally to get us to this net zero goal. And you can see the various tranches there of the requirements where they're going to be drawing this industrial metal, or sorry, not industrial metal, but this investment from, which will require industrial metal, energy, and other natural resources to get that.